How do we evaluate a credit default swap? In this video, I'm going to share how I implemented a credit default swap valuation in Java and discuss with you some of my observations. Now, let's pretend you are a fund manager in a pension fund and you want to invest in a corporation called ABC with a credit rating BB. If you purchase bond from ABC Corporation, in case ABC Corporation bankrupt, you might lose all your investment. Now, you can purchase CDS from an insurance company which is rated with AA. After you purchase the CDS from this insurance company, it is like you purchase insurance for your car. So you will pay insurance company premium, and in case the ABC Corporation bankrupt, the insurance company will pay back your investment. But if ABC Corporation didn't default, and then you just pay premium, the insurance company won't pay back to you anything. And this AA rating for insurance company and BB rating for ABC Corporation coming from a rating company like Moody's or S&P. Then how do we evaluate a credit default swap? Like I mentioned, the pension fund will pay the premium to this insurance company as long as ABC Corporation doesn't default. And also, in case of ABC Corporation's default, you also need to pay expected accrual to this insurance company. And when ABC Corporation defaults, pension funds will receive payoffs by the CDS seller. This model is based on John Hall's book, Options, Futures, and Other Derivatives. And there are several assumptions. Interest rate remains constant over time. That means we didn't use any model to forecast interest rate movement. Probability of default is given without modeling. Loss given default is given without modeling. And payments on the CDS are made once a year. Defaults always happen halfway through a year. Now, let's see my implementation. First, I will receive input from user for interest rate, probability of default, loss given default, and then maturity. And then I will calculate the PV of payments by the CDS buyer. This is in case the bond issuer does not default. And after that, I will calculate expected accrual and payoff by CDS seller if bond issuer defaults. After I calculate PVs, from those PVs, I will calculate the spread for this credit default swap. It's difficult to understand by just viewing this source code. So let's go to the user interface. In this model, I assume interest rate, probability of default, loss given default will be constant. That means they will not change over time. And first, let's assume the interest rate is 0.05, PD is 0.02, and the loss given default is 60%. And this bond will be matured in 5 years. In this model, I'm considering 1 unit of the notional. If you have a $10 million of this ABC Corporation bond, you just times my result with 10 million. That will give you the dollar amount of the CDS price. So on the left side is payments by the CDS buyer. Now this part is showing expected payments. We calculate probability of survival for each year, and then we calculate discount factor. Based on the probability of survival and the discount factor, we can calculate the PV the CDS buyer should pay to this insurance company. Then we sum up all the PV to get this amount. This part shows when the bond issuer does not default. When the bond issuer did default, we need to pay expected accrual to insurance company. And we consider every 6 months or half a year. In this column, I calculated expected accrual, and then based on the discount factor, I calculated the PV of this accrual. Again, I sum up all the PV of accrual to get this amount. If we sum up this PV of the payments and the PV of accrual, this will give me the PV of the amount paid by the CDS buyer. On the right side, I calculated the payoff by CDS seller. This part shows in case the bond issuer did default, how much the CDS seller should pay. First, we calculate the probability of default, and then we calculate percentage of notional by times probability of default times the loss given default, and then we use discount factor to calculate the PV. The PV is showing in this column, and after we sum it up, it shows this amount. The basic logic is the payments by CDS buyer and also the payoff by CDS seller, they should be equal. Otherwise, it's not a fair deal. And when we calculate the spread, we use this formula. We sum up expected payments and expected accrual, and times the spread should equal to payoffs by CDF seller. And because we have all those amount available, we can solve this CDS spread. And in this example, with those parameters, we can see the spread is 124 basis points. Now, let's do some experiment. If we change the maturity, say if we put maturity as 3, not 5. We recalculate. You can see the spread remains the same. That says the maturity will not affect the spread. If we change it to 2, recalculate, still shows the same spread. Now let's change the interest rate. If we change the interest rate to 0.1, recalculate, you can see the spread changed a little bit. Now let's change the probability of default. If we double this number from 0.02 to 0.04, recalculate, you can see the spread increase the value. It's more than doubled amount. Now, if we change loss given default from 0.6 to 0.8, you can see the spread also increased, but didn't increase dramatically. Now let me summarize my observations. Maturity does not affect CDS price. Interest rate doesn't affect CDS price much because it is only used for discounting. In this model, I just input PD, LGD, and interest rate without any modeling. I have another video showing how to model EAD, PD, and LGD. And also in my channel, you can see another video showing how to forecast interest rate movement over time with whole white model. You are welcome to watch those videos. Loss given default affect CDS price a lot. And lastly, probability of default affects CDS price dramatically. This is how I evaluated credit default swap in Java. Please provide your comments and subscribe to my channel. Thank you.